Welcome to the Mortgage Foundations podcast, where we are here to guide you through the ins and outs of the mortgage world. Get ready to unravel the complexities and gain a solid understanding of everything you need to know about mortgages. Whether you're a first-time homebuyer or a seasoned homeowner, we've got you covered with expert insights and tips. Let's dive into the fascinating world of mortgages together. In today's episode, Tyler Cowell, the principal broker of Mortgage Foundations, FSRA number 13614, will discuss mortgages for self-employed individuals and the different programs available for them.
When it comes to understanding a mortgage for a self-employed individual, it is critical to recognize that the core principles of the mortgage remain the same whether you are self-employed or employed as a traditional employee. The process of securing a mortgage for a self-employed individual can be a bit different due to the nature of their income. Unlike a traditional employee who receives a steady paycheck, self-employed workers typically experience variable income streams that can fluctuate widely from month to month or year to year. This can make it slightly more challenging for a lender to assess the client's ability to repay the loan. In order to obtain financing for a self-employed individual, the job of a mortgage broker is to work with the client to gauge how best to demonstrate their financial stability and reliability to lenders. Every lender will have different policies on which type of self-employed clients they will work with and how they assess the client's income as presented. This is why many self-employed individuals may find it challenging to obtain a mortgage, even from their bank they have dealt with for many years. Many times there will be additional documentation required beyond the standard requests for someone that is self-employed. Lenders will often look for documentation such as the company's financials, 2 to 3 years of tax returns with NOAs, 6 to 12 months of bank statements and ownership documentation to show at least 2 years of self-employment, like the master business license or articles of incorporation for an incorporated business. The down payment required for a self-employed individual can be as little as 10% depending on the structure of the client's self-employment. However, we traditionally see a mortgage for a self-employed individual requiring a down payment of 20% due to the client's income structure. The source of the down payment is also important with a self-employed individual, as lenders may not allow gifted down payment and require that the down payment be fully from the client's own resources. There are many mortgage programs available for a self-employed individual. The availability of the different programs mainly comes down to how the client pays themselves from their business. The simplest way to calculate the client's income is by looking at the client's verifiable income. This is how much is shown on the client's tax return, and in many cases it does not provide much qualifying power as their net income may be low. The reason for this is that self-employed individuals have a different way of declaring their income due to advantages provided by write-offs and other tax benefits, especially if the individual is incorporated. An individual that is incorporated or owns an incorporated business has a few options when it comes to paying themselves from the business and may even pay themselves only enough to cover their personal expenses while electing to keep money within the business. The benefit to this is a lower taxation expense. However, the trade-off is that there may be issues qualifying for a mortgage based on the client's income. This is where a stated or declared income mortgage product comes in. These mortgages may require the client to declare their income, and the lender will use different methods to verify and ensure that the declared income is realistic and will provide an opportunity for the client to repay the mortgage. These mortgages may feature slightly higher interest rates and have fees, although when compared with the tax savings, the higher interest and fees make much more sense than paying more tax to the government. It is always recommended that clients discuss their financial situation with their accountant and financial advisor, as well as their mortgage broker, in order to structure their finances in such a way that provides the most benefit to the self-employed individual. Having professionals in each field involved in the process and providing feedback is crucial. More and more people in Canada are choosing to be self-employed, and lenders are responding with different mortgage products and programs in order to provide these individuals with an opportunity to obtain financing for a dream home for them and their families. In conclusion, a mortgage for a self-employed individual is the same as a mortgage for a client that is employed in a traditional manner. The difference comes down to how the client's income can be calculated. There are different options available. However, some of these options may not be available based on the client's verifiable income. It is important that a self-employed individual work with a mortgage broker in order to review the different mortgage products available to them and ensure they have the most suitable option in place for them and their family. Feel free to reach out at 905-440-5392 with any questions on self-employed mortgages or anything else mortgage related.
In today's episode, we explored mortgages for self-employed individuals and different programs available. We hope you found today's episode informative, and don't forget to hit that subscribe button to stay updated for our next episode. Thank you for tuning in to Mortgage Foundations, and remember, every home starts with a foundation. Your mortgage should too.